be able to complete the valuation. And then tomorrow we'll get into the analysis of the values and or look at other investments or matters relating to investment recommendation and all that, right? Like research reporting and all those kind of stuff. All right, so I hope you're all doing well, right? Let me see something in the chat to know that your attention is here. Prince, Evans, Sifas, McJordan, let me see something in the chat. Let me hear from you quickly before we start. Quick. Let's get that done really quick before we proceed. Okay. Yeah, McJordan. Yeah, I'm also good by God's grace. Michael, I'm doing well. I'm doing well by God's grace. Okay, great. It's exactly 19 minutes past 5 by my clock, and it's a good time to resume work. So first, what we're going to do is that we'll look at what we were doing yesterday, and then we take it from there to the lecture for today. I have my Excel. Let me see. GCB bank. Okay, I think work is right. Yesterday around 7:51. That was the last update. I believe it's correct. Yeah, good. Great. So let me know if you can see my screen. It's been shared. Share my screen now. Let me know if you can all see my screen. All right, thank you. Now, let me push this somewhere. Also close the formula bar a bit. And okay, so yesterday we started looking at, let me put this back, base case scenario. We started looking at the valuation side of things, and we started with the free cash flow to equity valuation. And we came out with some initial valuation. And so that's what we did yesterday. There were some few issues with the work because of the estimated value, the final one. But today, what we're going to do is to get to another method, look at another method again, and that is a residual income. Let's get into the residual income quickly, and let's understand the rationale behind the use of the residual income model, and then we run quickly back to SL to look at how it is done. So today is May 13. Let me share my screen so you can see my PowerPoint. So yeah, so we were looking at lesson 1. We couldn't complete lesson 1 yesterday, which is on intrinsic valuation methods. And so we looked at Y equity valuation, we look at the methods and all that. We looked at the free cash flow to equity for the banks, and then we built a model. Today we're going to be looking at residual income model. Well, when it comes to the valuation, I trust the workings rather than going through a lot of theories. But again, the theory is very important. Theory is very important because it helps me to set the context to provide you basis for the methodology that you'll be using. And it's good to understand why we're going to do something the way we are going to do it rather than just getting into it. That's very important. So the residual income model, so this is the mathematical expression of the model. So we're going to look at something we call the excess returns, right? And that excess returns will be discounted and then added to the book value of equity. So that gives us the value of the business. That's just simple. We look for something called excess return and add it to the book value of equity, the current book value of equity, and then all these things will give us maybe the value for a business. Now, that excess return, there's a way it's calculated. Excess return, same as you can consider it, same as the residual income, is actually the return on equity, the return on equity minus the cost of equity. So I'm going to get into this very soon. But what this means is the return on equity is the return the business is generating on the equity capital, right? The return the business is generating on the equity capital. And the cost of equity is how much it costs the business to raise the equity capital. In other words, the minimum return the investors are expecting from the business. So take it this way, that return on equity is what the business is giving to investors, and cost of equity is what investors are expecting from the business, right? Good. So we'll get into details of this one. So the book value of equity there is, take it as the total investments that the investors have made with the company. So you are taking what the business is giving investors, which is the return on equity, minus what investors require from the business, and then multiply that by the book value of equity. Now, if what the company is giving to investors or the business is giving to investors is more than what investors expect or require, then we say that the business is creating value, or the company is creating value, because they are giving something more than what investors require, right? So that extra value created, or that extra return, when you multiply it by the beginning book value, it gives you the residual income. And then we tend to discount that residual income to today and have it added to the book value today. So we take the book value today, and then we forecast the residual income. We forecast residual income into the future, and then we multiply, and then we discount it back to today. So that is what the formula is saying. Let's get into this, right? Now, so what then is residual income? And here, well, I say I'll do a bit of reading, yeah? So suppose historically a company achieved a return on equity of 15%. Let's take it like that. And you know how return on equity is calculated. That is net profit, or profit after tax, divided by total equity, right? So suppose historically a company achieved a return on equity of 15%. The book value of equity as per the last balance sheet date, let's say 31 December 2024, is, let's say, 950 million. So this is an example I'm giving. If a company historically achieved a return on equity of 50%, 15%, let's assume for a purpose of argument that for a purpose of argument, let's just say that they achieve that return on equity of 15% on average every year that hold again. Okay, let's just say it's flat, 15%. And we are in 2025, right? So the last balance sheet date was 31 December 2024. And let's say the total equity as per that balance sheet was 950 million. Now, suppose the company's cost of equity is 12%, or in other words, the minimum return investors expect from the company is 12%. Then how do we determine the residual income, which is excess return, in 2025? Well, we know that the formula for residual income is what the company is giving to investors, which is the return on equity, what the company is generating on the money the investors gave to her. So the money the investors give to her is kind of like the value of equity, right? What the company is generating on that equity minus what investors require from the company. So that's the ROE minus cost of equity times the beginning book value of equity, which is kind of like at the beginning of the year, which is at the end of the previous year, 31 December 2024, the value of equity. That's the book value of equity. So you can see that I'm looking at residual income at time I, look at them subscript, right? And you see that this residual income at the end of year I or time I is equal to the ROE minus cost of equity times the book value of equity at time I minus 1. Now, what this means is this. Time I, take it as the end of 2025, 31 December 2025. Time I minus 1 is the end of the previous reporting date. That is 31 December 2024. So when we're calculating residual income, we are taking the ROE minus the cost of equity and multiplying it by the book value of equity, as at the last balance sheet date. And we have all that. Well, the return on equity is averaged at 15% historically, so we can say that that is what we expect to achieve in 2025 as well, minus the cost of equity of 12%. So that gives us the excess return. 15% minus 12% is the excess return. Then we multiply that excess return by the value of equity, 950 million. That gives it the residual income. All right. I've just been wondering why I repeated this twice, right? All right. So the residual income is 28.5 million. So that's very simple, right? Guys, that's very simple. And the model is quite simple, and it is. So the residual income is more of the cash flows, right, that a business will be getting. All right, let's look at it. So we're going to look at the rationale for such a model. And I told you the nature of the model. Let's go back. The nature of the model is this. We forecast the residual income, discount them to the present value, and then add it to the current book value of equity. What is the book value of equity now? Forecast residual income, discount it back, and add it to the book value of equity now. Okay. So, residual income model. Let's look at the rationale for the model. Number one, and these things are very important, guys. A company can have positive earnings, but may still not be adding value for shareholders if it does not earn more than its cost of equity capital. Let's take it again. A company can have positive earnings, meaning positive profit after tax is positive, right? Positive earnings, but may still not be adding value for shareholders if it does not earn more than its cost of equity capital. Let's go back to the formula. This is the formula we have here. This is the formula. Residual income is equal to ROE minus cost of equity times book value of equity. So when we say that the company is adding value, means that it's generating returns, or the return on equity is more than the cost of equity, meaning the company is adding value. But the fact that you have a positive earning, and positive earning, ladies and gentlemen, positive earning is just to say that the ROE is positive. Because ROE is return on equity. The numerator is earnings, right? So if you have positive earnings or you have a profit, you earn a profit, the numerator will be positive. And here we assume all the time that equity is also positive. Now, so if I have the ROE to be positive, it means that the company is profitable. I want us to get this. A positive ROE means the company is profitable, provided its equity is positive as well. Because if equity is not positive, book value of equity is not positive, we don't even calculate return on equity because there's nothing to return anything on. Is that okay? Now, so if a company's ROE is positive, then it means the company is profitable. In other words, the company is generating profit. But it doesn't mean the company is creating value. For value to be created, or to conclude that value is created, we expect that the return on equity is above the cost of equity. In other words, we expect that the return the company is generating is higher than what shareholders expect. Then we say value is created. Because if the return that the company generates is, let's say, equal to what the shareholders expect, then no additional value is created. You are giving to shareholders what they expect. Right? Good. So that's the first point. So a company can have positive earnings, but may still not be adding value to for shareholders if it does not earn more than its cost of equity capital. Second point, a company that is generating more earnings than its cost of obtaining capital, that is the one with a positive residual income, is creating value and vice versa. And that's what we just said. If your return on equity is greater than your cost of equity, you are creating value. Otherwise, you are destroying value. Let's look at the third one. Forget about those in the bracket. Higher residual income should be associated with what? Higher valuation. So a company that is having positive residual income, what it means is that a company is creating value. And a company that is creating value should have a higher valuation than a company that is not. So a lower residual income relatively should have a lower, associated with a lower valuation. Now, in the long term, companies that earn more than the cost of capital should sell for more than book value and vice versa. Oh, okay. Now, you see, the whole idea is that when we take the balance sheet, what do we see? We see total equity. And we often say that the total equity on the balance sheet may not be the same as the equity value of the company on the stock market. So the stock market value, which we call the market capitalization, may be above or below the total equity on the balance sheet, which we often call the book value of equity, right? Now, we can explain that phenomenon. We can explain why that happens. And the explanation we can give is that if a company is generating a positive residual income, then that company will have its market capitalization higher than the book value of equity. And then if a company is generating a negative residual income, you see, a negative residual income means that the return on equity is falling short of cost of equity. Or in other words, the company is not able to generate enough return to cover cost of equity. So if a company is generating a negative residual income, then its market capitalization will be lower than the value of equity on a balance sheet. Now, let's check whether that is true. Going back to the earlier formula I showed you here. Check out this, the last one here. Check out this. A moment. Okay, check out this. Check out this. Now look at the last one here. The equity value today, which is year zero, is equal to the book value of equity today. That's the value on the balance sheet, plus an adjustment. You see, what happens is that with the residual income, we know that the book value of equity on the balance sheet may not reflect the market value of equity. We know. Now, that being said, given that we know that, when we are doing a valuation using the residual income model, we take the book value of equity on the balance sheet as a starting point. Okay, so we take that as a starting point. We take that and then do an adjustment. Now, roughly speaking, the nature of the adjustment is such that we take the book value of equity and then we add something to it or we subtract something to it, depending on whether the company is creating value or not. In other words, depending on whether the company is expected to create value in the future or not expected to create value in the future. So the book value of equity is taken, then we ask ourselves, is the company expected to create value in the future? If yes, then it means that the company's value will be higher than the book value. Meaning that we're going to take the book value of equity today, then we add the potential value created, or that will be created to it. If we could not answer the question, and the answer then perhaps is that the company will not be able to create any value, and also not just creating value, the company will neither be able to create value nor destroy value. In other words, the company's returns will be exactly what investors want. What exactly investors want is what the company will be given. In that case, the return on equity will be equal to the cost of equity. If that's the case, then there will not be residual income. There will be neither a positive residual income or a negative residual income. So residual income is zero. Now, since residual income is zero, the company is neither expected to create value nor destroy value. Then it means that the company must be trading at the book value. So in other words, the market price of the company will resemble the book value of equity. Now, so no value is created. So if you check the formula here, you'll see that the second term in the formula, we have book value of equity plus the sigma talking about summation, discrete sum, right? The sigma residual income times discount factor, we sum up all the forecast residual income times the discount factors, we sum them all to give us the present value of future residual income, which is the value created, right? And so if there is no residual income, then that entire term becomes zero. So the equity value on the market will be exactly the book value of equity. And the third point is that if the company is expected to have a lower ROE relative to the cost of equity, or the company is not expected to create a positive residual income, in other words, creating a negative residual income, then it means the company will be destroying value. So in other words, shareholders have committed money to you, that is a book value of equity, and then you go ahead to destroy it. So as the more your return on equity falls short of the cost of equity, you are kind of like, you're not giving to shareholders what they really expect, right? What they really expect is the cost of equity, and you are giving them the return on equity. And so you can see that because you are not giving them exactly what they expect, is like there's a distraction in value. There's a way to look at it, guys. Let's think about this way. It works this way. Take the cost of equity as what the company must pay to investors no matter what happens. Okay, look at it that way. So here, in the example here, the cost of equity is 12%, right? The 12% must be paid to investors no matter what happens. So where would they pay from? They will pay out of the book value of equity. So in other words, at the end of every year, the shareholders will expect the company to pay 12% of the 950 million to them. Now the company must pay the money. So why will they pay the money? Well, they can pay that money smoothly if they make enough returns, right? Or they generate profit. Now, so if they are making 15% return, it's easy to pay shareholders back how much? 12% return. And then some will even be left. That will be the 6%, 3% that will be left. That 3% is the extra value created. And that will not be given to shareholders, so it will be added back to the book value. And that's so you could see that the book value will be growing, right? I wanted to look at it in that context, right? It will make the residual amount growing. Like you make 15%, you give 12% to shareholders, 3% left, to add it back to the base amount, right? So that's growing. And that's what shareholders want. So you're creating value. Think about a situation where shareholders want 12% and you are giving them only 9%. You must give them the 12%. What will you do? Because you are making a return of only 9%. You are going to take that 9% and look for some 3% somewhere to add to it to meet that 12%. Where are you going to go to? You will go to the book value, take some money from the book value and add to it. Think about you managing an investment fund, and you need to meet the objective of a client. And one objective of the client is that every month I want my portfolio to perform such that I am able to get about 10,000 cedis to meet my personal expenses. And now maybe in a particular year or a particular month, the portfolio underperformed the objective, and the portfolio was recording 8,000, right? Return. Able to make 8,000 return, but you want 10,000 return. So what do you do? Because you need to still meet that. You're going to, less strictly speaking, right? You're going to take the 8,000 returns on the portfolio, then you remove 2,000 from the asset under management. Then you add it to the 8,000 and give to the client because you must meet that 10,000, right? So what is happening is that the client's asset will be dropping in value, right? That's exactly what's happening here. So going back here, so a company that is okay, we talked about that. I said higher residual incomes be associated with higher valuation, and in the long term, companies that earn more than the cost of capital should sell for more than book value, and that's what I've just explained. Let's get into it now. So when you check the residual income model, actually, this is the model structure. The equity value, we have the book value of equity plus the residual income multiplied by the discount factor. So the set of residual income forecast in the future multiplied by the discount factor, right? Then you get a present value of residual income, which is the second term here, the present value of this residual income. Then we add that to the current book value of equity, and I've explained all these things. So you see that the residual income model actually is in two parts. One part is the current book value of equity. The second part is the present value of expected future residual income. The interesting thing with residual income is that the significant part of the value you end up getting is in the present value, which is the book value of equity. We know it today. So it's not actually sensitive to future assumption. That sensitivity is low. I'm not saying quite not sensitive, but it's not extremely sensitive to future assumption. The future assumptions surround the assumption around residual income, right? And discount factors and all that. But given that the significant portion of the equity value is in the book value of equity today, the entire equity value is not extremely sensitive to future assumptions, as we see in the case of free cash flow to equity, right? So it's not extremely sensitive to that. Now, there's a reason why the financial services firm tends to mostly be valued by the residual income model. One, given that the book value of equity is what matters a lot to regulators and also to investors, because a bank will stop existing if it doesn't have enough capital, right? And that's a matter of equity. That's one point. The second point is that most of the items on the bank's balance sheet are fair value. The significant items on the bank's balance sheet are the loans and advances and the investment securities, the deposits and all those things. Those are significant stuff, right? And they are all measured to fair value, right? They are all measured to fair value. Given that they are all measured to fair value, asset minus liability is likely to be very close to fair value as well. So the book value of equity is likely to be very close to fair value. What is on the balance sheet is likely to be very close to fair value as well. So, and given that book value of equity dominates, the residual income model tends to be much more reliable than the free cash flow model when used to value banks, right? So let's get that. And on any day, anytime, I'll prefer the residual income model above the free cash flow model for banks. Good. Right. Of course, I explained how some of these stuff are done in the computation of the residual income. But because if you check the formula, if we need to forecast anything at all into the future, there are just two quantities we need to look at: how to come up with a residual income forecast, and number two, how to come up with the discount factors. But the discount factors are now almost like something we've been doing, right? We know the discount factors. We already calculated it, and it's common to all the equity valuation methods. So if we are using 27% with a free cash flow to equity, we come to residual income, we use the same thing, right? So the assumption or the key assumption we need to formulate going forward has to do with the residual income. So the computation of the residual income is key. And I explained that a lot, right? And when we start the SL work, we get to understand things better. All right, there's something that must work for a residual income model to work. For it to give us a good value, something needs to work. I need to open. Let me open a financial statement quickly. I believe I have GCB's financial statement. I mean, the annual report is all right. Not just the annual report. I don't know if I have the full annual report here. I want to show you something really quick. those of you that may not spend much time with financial statement, so you get to understand things better. There are some, there are some things that if you have been working with financial statements, you tend to understand. Uh, I think not on this laptop that I have. I have them. I have them on my MacBook there. Okay, let's proceed. I'll get back later. But I believe it's something which we can all relate. Now, forget about clean surplus assumption for now. Let's talk about this. When we take the financial statement of a bank and or of any company at all, we have the statement of comprehensive income, which you know. Then we have the statement of financial position and statement of cash flow. Now, when you take the statement of comprehensive income, you'll notice that the statement of comprehensive income is grouped into two. It's a single statement, but it's in two parts. The first part is on profit and loss account. The second part is on other comprehensive income. So the profit and loss account, the final line item on the profit and loss account, or on the profit and loss account, is the profit after tax. That's the final line item. Then we have the section called other comprehensive income. So that section called other comprehensive income also sums up to give us what we call total other comprehensive income. So when we add the other comprehensive income to the profit and loss for the year, or the profit after tax for the year, it gives us what we call the total comprehensive income. Now, generally, I explained this some time ago that generally, transactions that are unrealized mainly are classified under other comprehensive income. Okay. And the unrealized, the nature of the unrealized transaction is such that they are not expected to be realized within that period. Okay. They are not regularly realized. Think about a situation whereby you revalue assets. If you revalue assets and you don't even have any intention of selling the assets now, that revaluation gain has to flow to other comprehensive income, right? Or maybe you have some equity securities in a company which you don't intend selling anytime soon. So that goes to other comprehensive income, the gains and losses on that. Good. So you see that the other comprehensive income items also flows to the balance sheet. Now, the profit after tax flows into the balance sheet through the line item called retained earnings. So when you go to retained earnings, you see the profit after tax added to the retained earnings. Now, the other items in the other comprehensive income, like the revaluation gain and loss, fair value measurement or fair value gain and loss on items classified as other comprehensive income, foreign exchange, translation gains and loss, foreign subsidiary, and all those kind of stuff, right? FS stuff that are classified as other comprehensive income. Those items also get into the equity section of the balance sheet, but they flow into other items, and we'll see them soon. You see them flowing into items like, let's say, fair value reserve, other reserves, and all those kind of stuff. Now, they don't flow through P&L accounts. They flow through the other comprehensive income, and so they get into other reserves. By the end of the day, they add up to total equity on the balance sheet. I'll show you soon in the GCB financial statement you have in the model. Now, so because they don't flow into the P&L, they don't get featured in the computation of the return on equity. So the return on equity is calculated classically, and a matter of practice, return on equity is calculated using the profit after tax. So profit after tax divided by total equity. But that is mostly wrong for the purpose of the residual income. Okay. Yeah. So the whole idea is that because the other comprehensive income items don't flow through P&L or are not part of profit and loss account, they get to be missing out when we calculate the residual income, because the residual income, you are looking at return on equity minus cost of equity. Now the return on equity is calculated using the profit after tax. Well, why are we saying it's missing out? Think about it this way. When we go back and look at a formula here for residual income, we have return on equity minus cost of equity times book value of equity. Meanwhile, this book value of equity includes not only the P&L items, it also includes other comprehensive income items like revaluation surplus, fair value reserve. All those kind of things are part of the book value of equity. And you are multiplying that by the return on equity and all that. So generally what is happening is that there's almost a mismatch here. Now, so the clean surplus assumption is saying something. It's saying that, in fact, this is the relationship the clean surplus assumption says. I've just explained something to you. Let's put it aside. Let's talk about the clean surplus assumption. Clean surplus assumption says that the movement in the book value of equity from one year to another should be fully explained by the P&L account. Or in other words, should be fully explained by the earnings after tax and transactions with owners of the company. So when we say transactions with owners of the company, it includes dividend paid to owners, maybe the issuance of new shares. Okay, so when we take the book value of equity this year versus the book value of equity next year, the reason why there's difference should be because of profits after tax added, or some dividend paid out, or maybe shareholders brought in new money. Let's put shareholders' money aside. And let's say there had not been any addition to shareholders' capital from shareholders themselves. So the only reason why equity on the balance sheet is growing should be because profit is made and also dividend is paid. Any of these happening or both happening. Now, so if that's the case, then it means that if we just use the financial statement the way it is, we are going to have problem. Because the financial statement the way it is, the movement in the book value of equity is not fully explained by just earnings after tax and dividend. No, it's explained by earnings after tax, dividends, and other comprehensive income items like fair value on gains or losses, revaluation gains, blah, 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 blah. They are all explaining that. Pension, actuarial assumptions on pension, like actuarial gains and losses and all that. They are all part of the explanation. So we ignore them? No, we can ignore them. So what we are going to do is that we're going to take the P&L account, we're going to take the net profit as a starting point, and then we're going to adjust the net profit, and we are going to make an assumption that those items that are reported under other comprehensive income should have been part of income. Or should have been they should have been part of earnings. So we add them back to earnings. We'll add those items back to what? Earnings. And that's what we're going to do. It appears, it sounds away, but that's how it's supposed to be, right? So we're going to pick the other comprehensive income. We'll go back in history and add back the other comprehensive income as though they were part of profit. And then that is what we're going to then use for our work. Or that's what you use as basis for the computation of the return on equity, and then do our valuation. We're going to see it soon. Good. So that is the issue of clean surplus assumption, and it must hold. Next thing here is when we're talking about the residual income model, there are some assumptions or some things that we must get right, and in estimation of the residual income. And then we need to also check the book value. Look, we can't just take the book value on a balance sheet and say, oh, the book value is this, so that is what we're going to work with. There may be problems with the book value. There may be serious problems with the book value itself, and we need to look into it. the book value may not be accurate. The book value may not be reflective of what the value should be, or may not be reflective of the true position. If we take financial services firm, because the assets and liabilities are measured to fair value, we tend to have a more reliable book value. But that doesn't negate the fact that there may be potential issues that need to be adjusted, right? Now, so there are three sources of, or three areas I'd like us to look at. Balance sheet adjustment, because the book value is reflecting mainly just the on-balance sheet stuff. Reflecting the on-balance sheet stuff, well, people can say that some off-balance sheet adjustment will pass to banks' balance sheet. If you think about it, one thing that is done is impairment charge on off-balance sheet commitment and letters of credit. But even in that case, that impairment is now deducted from the loans and advances on the balance sheet. It is actually added to P&L though, so it's added to the impairment that is reported on the P&L. So the P&L impairment for the year includes the off-balance sheet as well. And then oftentimes what the banks do is that because they deduct it from the P&L, they tend to reduce equity. There's another way they have to pass it so that the balance sheet will be in balance. And what often a lot of the banks do is they add it to other liabilities, right? That particular impairment, because we can take it out of the gross loans, and because it's off balance sheet. So already some off balance sheet things are being accounted as though they are on balance sheet, right? Now, so what we do is that we need to scrutinize some stuff, right? So identify and scrutinize the significant off balance sheets. I wanted to say on balance sheet assets and liabilities to determine the need for further adjustment to the reported book value. So if I was talking about on balance sheet, right? So what I mean here is that you take the financial statement, the annual report, you need to read the notes surrounding the annual report. There may be some issues associated with the bank, and you can, from there, you can get some insight and use to adjust the loan. So sometimes financial due diligence report on the company is a good starting point. If they have financial due diligence report already, maybe they have some bad loans, or the impairment charge on the loans is insufficient and there's need for additional impairment. So those are potential unbalanced adjustments that you can pass. So further adjustment is necessary if the fair value of the assets and liabilities are significantly different from their book value as reported on the balance sheet, because you check, but for that is, or what I'm writing here is for general practice. I mean, if I say general practice, I mean applicable to all sectors. But if we come to the banks, oftentimes the fair values are closely matching the book value, but there may still be the fact that the assumptions made around impairment charges and all that may be understated, and there may be a need for a revision to some of those assumptions. So you, after a review, you may realize that there may be a need for additional adjustment to the book value again, right? So the book value of equity may be adjusted further. Then off-balance sheet adjustment. So you examine the off-balance sheet assets and liabilities through examination of the notes to the published financial statement and discussions with management. So when necessary, you adjust the book equity book value again. Now, the whole idea is that the reason why equity book value will be adjusted in this case is that because if we review, let's say, the impairment charges, and we notice that additional impairment have to be charged, when it is charged, where does it have to go to? Often, when impairment is charged in a normal course of work, we pass it through the P&L. So here, it's going to bypass the P&L because the financial statement has been prepared already. So it's going straight to hit on the book value of equity, since we are doing this historically, right? And then reduce the book value of equity to start with. Now, so there are some sample items you need to review. And the operating leases, there may be issues there. Deferred tax assets and liabilities. For the deferred tax asset is where a lot of people actually focus their attention. For liability, because of conservatism, we don't want to worry ourselves too much. But for a deferred tax asset, we want to see whether that deferred tax asset is even necessary. If we review and realize that it's not necessary, we'll take it out of the book value of equity. So we take the book value of equity and we subtract deferred tax asset. A lot of people do that. A lot of people just adjust it. No matter the case, they adjust the book value of equity by the deferred tax. But let me tell you why you may not have to take that hasty decision. One, you see, the defector's assets could be valuable if the company is making profit. Like GCB like this is making a lot of profit. So defector's assets are valuable. I explained this some time ago, so I don't want to get in there more again. Inventory valuation for general companies, right? You may have to do inventory valuation, revalue the inventory, maybe additional payment may be needed, or write-off. Intangible assets, some of the intangible assets, especially if you take a balance sheet and the huge portion of the balance sheet has intangible assets, is made up of intangible assets. There may be a need for you to apply some discount, depending on the industry you find yourself in. For banks, intangible assets is not a big thing on their balances, so not really something to worry much about. You can negate it, right? And reserves. The reserves here has to do with whether those reserves are even merited. But for banks, the key reserves like statutory reserves and stuff, you don't need to adjust. Just leave it the way it is, because those are just transfers made from P&L, right? Profit for the year. Now, so I showed you a very simple model, the residual income model, and you may be thinking that the actual application is also going to be simple. Well, it's going to be simple, but the whole idea is that there are a lot of assumptions that must be made, and those assumptions may make the simplicity a bit complex. Okay, so let's get some key points to note. Now, so residual income may persist after the explicit forecast period. You know, we have the explicit forecast period, and in our case, for GCB, we are using a 5-year period. We are forecasting over a 5-year period. Then we do the valuation. Now, beyond the 5-year period, decisions have to be made. Will residual income persist beyond the explicit forecast period or not? So there are 3 scenarios we need to look at. Scenario number 1, residual income, or let's say hypothesis, right? Residual income will persist, or let me just call it scenario. Residual income will persist beyond that period, beyond the forecast horizon. I mean, the explicit forecast horizon. So residual income will persist. What it means is that if the company's return on equity is greater than cost of equity, it will continue forever beyond the forecast, explicit forecast period. The second scenario is that the residual income will stop right at the end of explicit forecast period. In other words, beyond the explicit forecast period, the return on equity will be equal to cost of equity, and therefore the residual income will be 0. So in other words, the final year in the explicit forecast period is the only year that a positive residual income will be recorded. Beyond that, a residual income will be recorded, whether positive or negative. Beyond that, it is 0. Remember the first one, I said residual income will persist forever. And if I say residual income, it can be positive or negative, depending on whether ROE is greater than cost of equity or vice versa. Now, and I said the second one is that residual income beyond the explicit forecast period will be 0. The third one is that residual income beyond the explicit forecast period will continue, but at a point in time, it will run to 0. So these are the 3 positions we need to look at. So if I say it will run to 0 at somewhere, which sometime in the future, which I'm not telling you which time is going to happen, but sometime in the future, it will result in 0. What I'm trying to say is that the residual income or the ROE will revert to the mean level. And the mean level of ROE is the cost of equity. Let me just use a mathematical statement and put it this way. The expected value of the return on equity is the cost of equity. The expected value of the residual of the return on equity is the cost of equity. So when I say that the ROE will revert to the mean level over time, I mean there will be a convergence. The cost of equity and the ROE sometime beyond the explicit forecast period will converge. You see, there may be a gap now. ROE is higher than cost of equity, but sometime in the future, the two converge. So there's a convergence. We can forecast that. Now there will be a convergence. Now, so three methods or three scenarios, sorry. First one is that ROE is greater than cost of equity, it will continue forever. Second one is that ROE will be exactly be equal to cost of equity immediately after the explicit forecast period. And the third one is that ROE and cost of equity will converge somewhere in the future, which is a convergence. Now, there are several factors that will explain why that will happen. Now, for ROE to continue forever, it means that the company in question will have a competitive advantage or a competitive disadvantage forever. That is a one ROE will continue forever. Residual income will continue forever. So a forever residual income, that kind of case. It can be a positive residual income or negative. Negative is when cost of equity is higher than the return on equity, and positive is otherwise, right? That's what we've been talking about most. And so that is it. The second one is that I said that the convergence is happening right at the end of the explicit forecast period. And this kind of like the competitive advantage or disadvantage will be, or maybe the market is extremely competitive such that the advantage or disadvantage may not go beyond the explicit forecast period. The other one, which has to do with the ROE and the cost of equity converging over time, the speed of the convergence is a matter of how long it will take the company to sustain its competitive advantage. Okay, so if the company, it will take longer for the company to sustain its competitive advantage, or the company can sustain its competitive advantage over a longer horizon, then it means that the convergence will not happen soon. So you can still see ROE above cost of equity to a longer period. If it's going to take shorter period because of competitive pressure, and then the convergence is going to happen really quick. And then in that case, of course, the residual income will not persist for too long. Now, so those are the three things I talked about here. Now, the first one, residual income will be zero. So here we assume the residual income will be zero from terminal year forward. Okay, that's the end of the explicit forecast period, meaning there will be no residual income going forward. No, so in other words, the terminal value, which is like we forecast up to, let's say, 2029, from 2030 going, since the business is going concern, we discount all those future residual income at the end of 2029. We call that terminal value. That's going to be zero because there will not be any residual income going forward, right? The second one I talked about, that the residual income will continue. Okay, the residual income will continue indefinitely at a positive level. So in that case, when we want to come up with a terminal value, something else must be done. Because residual income is going to continue indefinitely, what do? We know that residual income calculation is the ROE, that's the return on equity, minus cost of equity times the book value of equity. Let me take it again. Sustainable ROE minus cost of equity times the book value of equity. That's how we calculate residual income. Now, so the reason why now we're using the term sustainable ROE is the ROE beyond the explicit forecast period. We need to come up with a constant ROE that a company will assume to be generating forever. Okay, that's sustainable ROE. And we subtract the cost of equity from it and multiply it by the book value of equity. And that will give us the sustainable residual income. The sustainable residual income. Then we divide everything by the cost of equity. And you remember that perpetuity formula, right? The cash flow divided by the rates, right? That's perpetuity. And we looked at that yesterday as well. So we have the residual income divided by cost of equity, and that gives us a terminal value. That's for residual income lasting forever. Now, that also doesn't happen often because we don't assume that company will continue to have or sustain its competitive advantage forever, unless it's a monopoly, right? So the third assumption, which I talked about, residual income converging at a point. And this is the whole idea. I talked about convergence. I said it can converge now or fail to convert. And those are the two assumptions, the assumption one, assumption two. Assumption one says converging now. Assumption two says it will never convert. So in between the today and infinity, we may have convergence. And that's assumption three. Now, we need to make a key assumption here. And whatsoever terminal value we end up calculating will be very sensitive to the key assumption we'll make here. The key assumption we'll make is on the speed of convergence. And the speed of convergence is called the persistence factor. Now, let's look at something. Look at the formula here. You'll see that comparing assumption 2 formula, the denominator, which is cost of the denominator, to assumption 3 formula denominator, you will observe that some 2 items were added. Assumption 2 denominator is only cost of equity. Assumption 3 denominator, where there is convergence, we see 1 plus cost of equity minus persistence factor. So 2 more things were added, which is this 1 plus this persistence factor. Now, so it becomes easier for us to analyze the formula. So suppose persistence factor is 1. What happens? If the persistence factor is 1, then 1 minus this 1, let me use the laser pointer. Suppose the persistence factor is 1, then 1 minus this persistence factor of 1 will be 0. So all that will be left here with is the cost of equity. Is the cost of equity. That's all that will be left with, the cost of equity. And that will be assumption 2. So we can now define assumption 2, which is indefinite residual income, as the type of residual income where the persistence factor is 1. Now, if the persistence factor is 0, then it means that residual income will not continue again. The last residual income is the one forecasted at the end of the explicit forecast period, which is a sustainable ROE minus cost of equity. There's one more residual income, which is sustainable equity minus cost of equity, divided by the discount rate for that residual income. And the discount rate is 1 plus cost, or discount factor is 1 plus, sorry, discount rate, right? 1 plus cost of equity. You know how we calculate discount factor? We do 1 plus cost of equity to the power -1. So it's the same thing happening here. So if the persistence factor is 0, then the whole formula collapses to a situation where residual income will not continue, will not persist. So it means that the terminal value of a situation where there is a convergence will lie between a persistence factor of 0 and a persistence factor of 1. So the question is, which persistence factor are you going to use? The higher the persistence factor, the higher the likelihood that residual income will persist for long. The lower the persistence factor, the lower the likelihood that residual income will persist for long. So as we move towards 0, we are trying to say that residual income will not persist for too long. If we move towards 1, we are approaching a situation whereby residual income persists forever. Now, as to the choice, is an art. But think about it this way. It's a matter of your understanding of the business model and the competitive environment the business finds itself in. Right? Good. Wonderful. So that's residual income. Let me check if there's any question. I think I've communicated this in plain language. So it's a good time for us to implement the residual income model to the valuation. And are we ready to do that? Put something in the chat. Are we ready? Let me read something in the chat. Are you ready, guys? Are you ready? Yes. Okay. Sure. Absolutely ready. Great. Let's apply that to GCB. See. After this program, I expect that some of you that work in research, you can come up with a research paper, or individually, you can do this. You don't need to be working for a research company. You can come up with a research paper on the banks, right? The banks are listed on the market here, on whether you think their shares are overstated, understated, whatever. You can write your stuff, right? Overvalued, overvalued and undervalued rather than overstated. All right, so residual income. I'm going to duplicate the FCFE worksheet again. So I have that of residual income. Let me put it here. So I'm going to call this let me move it here. Residual income, or RI model. And this will be FCFE model. So RI model, residual income model. So I'll make some few changes here. So residual income model. And then here will be residual income model. I don't want to do all this all over again. That's why I'm just leveraging on this one. But a few things will change here. Let me take off the lines. I just want to leverage on this. Now, the first one, how are we going to do with the residual income is that we said that the clean surplus assumption must hold, that the movement in the book values must be fully explained by earnings and dividends. If that's the case, then what do we do? What it means is that let me check something here quickly. What it means is that we can have our earnings as per P&L. Then we have adjustments for other comprehensive income. Adjustment for other comprehensive income. And so maybe let me indent this. Then we have adjusted earnings. So we use that to start it. Then we have adjusted earnings, right? Once we have adjusted earnings, we will proceed to have beginning book value of equity, beginning book value of equity, and we will have in there adjusted earnings. We have adjusted earnings added to the beginning book value of equity. So I'll indent it. I'll indent that quickly. Then I have dividend paid. That will also be indented. Then we have closing book value of equity. Good. So maybe let me bring this a step down. Closing book value of equity. So we will have this. So the first thing we do, let's do this reconciliation first. So earnings as per P&L in 2024, earnings as per P&L in 2024 is this. We move it here. And then what we do, other comprehensive income adjustment. Now, I don't want to go to, I can go to the financial statement of the bank, right, and do that, but I don't want to. I mean, the annual report of the bank and support that, but I don't want to do that. What I want to do is that I want to take the balance sheet and check those things out of it. I'm moving the balance sheet to this side, so I can check the things quickly. So if I take the balance sheet, as I mentioned to you, the profit and loss run through the retained earnings. Then and also runs through statutory reserve, and then even credit risk reserve in a special way. So the other types of reserve are bundled under fair value reserve and other reserves, right? They are the ones containing the other things. So if I want to know do I make a mistake? I think I did. I made a mistake, right, guys? Nobody actually spotted that. The residual income, the opening. Okay, I got it right. I got it right. This is the earnings for 2024. Okay, I got it right. So 2024, the other comprehensive income items in 2024 can actually be estimated this way. I can calculate the total other comprehensive income values, which is more of these. Or in other words, what I can do is that I can take the total equity here in 2024 minus total equity in 2023, and that gives me this figure. All right. Knowing this figure, and have the question, have they paid dividend in 2024? No dividend was paid in 2024. The bank didn't pay any dividend for 2024. So I have this as a total change in equity. So this total change should be fully explained by the P&L. But we know that on the P&L, the total profit is this. So it means that there's an other comprehensive income item, which will be the difference. Okay, that's explaining this, which is 43. So this 43,181 is what I'm interested in. And that's what I'm sending to my my work. So I go to residual income, and then I do I go to statement of financial position. I take the total equity minus total equity in the previous year, which give me the total movement in equity. And I'm saying that the total movement in equity should be fully explained by the profit for the year because no dividend was paid. So I look for the profit for the year. I take it out of it. I realize that there's an amount left. So it tells me that this amount is another comprehensive income item. So what then do? I sum it up, and that gives me the total comprehensive income, or the adjusted earnings. Now, what's the beginning book value of equity? I think there's a question. Let me address that. Concerning the OCI, if we look at FY24, we see that the OCI item do not hit the income statement of that year. So why adding them to earnings instead of excluding them from equity? I'm adding them to earnings because they are part of total equity. They are part of total equity, but they don't flow through P&L. So we are adjusting the earnings as though the OCI has flown through the P&L. That's the assumption. It should have been done as though the OCI had actually flown through the P&L. The whole assumption is that OCI should flow through P&L for a clean surplus assumption to work. Otherwise, we are going to be doing the return on equity calculation on the net profit, which doesn't include those OCI items. But then when we are looking at the book value on which we calculate the return on equity on, the book value includes OCI, so that mismatch. Ibrahima, I think maybe you are a bit late to the class. That's why we actually explained a lot of the basis for this earlier. Thank you. All right, so beginning book value of equity, that is a book value of equity for 2023. We'll go pick that. And then adjusted earnings as calculated above, and then no dividend paid in 2024. So I can actually go to the equity side to check and link it under equity, right? I want my model to be fully linked. So I go to equity. I look at retained earnings. I'm looking for dividends, and I didn't see any dividend in 2024. So the closing book value of equity, and which then is the sum of all this. So you see, I expect this figure to be equal to the one on the balance sheet. Let's check it out. The one on balance sheet for 2024 is this figure. The two must be equal, and they are equal, and that's my objective. So I've been able to reconcile the closing book value of equity to the balance sheet. Okay. Now, so the earnings here, the book closing balance becomes the opening balance here for book value of equity, not earnings. And then we drag this one as well here. So we have this reconciliation done. Then earnings as per P&L, when we drag it, it gives us all our forecast earnings, right? Our forecast earnings. Then other comprehensive income adjustment, there is none. We don't actually forecast other comprehensive incomes. We don't try to do the forecasting of other comprehensive income items. So this is what we have. Then adjusted earnings, we have this. And so you see actually that the forecast aligns with what we have. Let's look, let me just bring here the forecast equity. So if I go to balance sheet and I'm looking at the forecast equity, bring it, you can see that it's the same as what we have there. You see, it's the same. In exception of which here, I think there's a bit of, okay, I didn't bring dividend. So let me drag the dividend as well. So you can see that the two are the same. 2029, it is 23 million or billion, and it's 23 billion here as well, right? Good. Now let's proceed. So now we have our closing book value of equity. Closing book value of equity all done. And we have our statement this way. If you're like me, I want to always put some of the borders around some of these things. And then the book value, also I'll put those top and bottom borders here. All right, so I have this. I can calculate my return on equity. So return on equity. And this is another side I want to talk about. You see, when we do receipt, maybe the usual return on equity we calculate. How do we calculate it? For the usual return on equity, we calculate the return on equity this way. The earnings for the year divided by the earnings for the year divided by the, how do they call it? The average book value of equity. Some people even use the closing book value of equity. So the earnings or the net profit for the year divided by the closing book value of equity, or by the proper way is to do divided by the average book value of equity, which is the average of the opening and the closing. That is how we do that for financial reporting purposes. Okay, and financial analysis purposes, not just financial reporting purposes. But this is the catch, right? For residual income, the return on equity calculation should be based on the opening book value of equity, because that's the capital given to you at the beginning of the year. And based on that, you have to earn return. So we do the calculation based on the opening book of value of equity rather than the closing book value of equity. In other words, if you check 2024, the opening book value of equity is 2.8 billion. During the year, earnings of 1.252 billion was generated on this equity book value. Okay, and any of this was generated on this. So when we do the return on equity calculation, it will be based on the opening book value of equity rather than the closing, which is 4.052. If you do it on the closing, you are going to get, let's just say you are just doing a closing, you do adjusted earnings divided by closing book value of equity, and that is going to give us, it has started raining. I hope my internet doesn't go off, guys. That's going to give us 31%. I hope you can hear me clearly. It's raining here. If you base it on the average, you are going to get something else. But for the purpose of the residual income, we base it on the beginning. So let's do that. So adjusted earnings divided by the beginning value of equity. Then we drag. This is the return on equity. This is how the return on equity is calculated. Okay, there's a question. Yes, we can hear you. Okay, good. Thank you. let me check this again. Let me drag with our formatting. Okay. So we have this done. Now, the next thing we need to look out for, there are several ways we can actually present this work, right? So we can bring the cost of equity here, cost of equity as well. So we see the cost of equity against the return on equity. And the cost of equity here is what we have it below. We have some valuation assumptions here. Some of them we will revise them, but we have some here. 27.8. We have it as a cost of equity. This cost of equity, we're going to anchor the formula and make it absolute and drag it all through to the end. So with this, we can calculate the excess return. Remember the tutorials, we calculate excess return, which is the return on equity minus the cost of equity. So let's see what this gives us. So the excess return is this. I don't know why I'm not doing this one. The excess return is this. Okay. So we have our excess return. Now that we have our excess return, what then do? We can calculate our residual income. So our residual income would then be the excess return, which is the return on equity minus cost of equity, multiplied by the beginning book value of equity. So we have that. Beginning book value of equity. So this is all we have as a residual income. Now, so we have our residual income calculated. And, there's one thing we've forgotten. Did we forget? No, I'm not sure. Okay, we've included it. I wanted to reach out to this dividend pay. I realized that we've concluded it. That's beautiful. All right, so we come to residual income here now. And based on these residual incomes, we can do our valuation. And consider we've been having positive residual income, all because the return on equity is sufficiently above the excess returns. Cost of equity. So you give an excess return. So this is a residual income. But again, as we often do, we need to also come up with terminal value of residual income. Now, you see that for residual income model, we don't need to have huge terminal value because most of the value actually sits in the book value of equity today. Okay, most of the value actually sits in there today. But there is one more thing I should have included. Apart from the adjusted earnings and dividends, there's one more thing I want to include. Okay, maybe we will not include it. We will not include it here. I'll show you where you include that. There's something I wanted to talk about. Now, we can do the terminal value computation, and the terminal value computation can be done this way. We need to look out for the persistence factor, right? So currently we have the valuation date, which is still relevant. We have the cost of equity, relevant, average ROE for industry banks. We have the dividend payout ratio, which we don't need here. We will need, in place of this, I want to introduce something called sustainable ROE. Sustainable ROE. We need a sustainable ROE. We don't need a growth rate. Do we need a growth rate? A growth rate in what? Maybe to say, no, we don't need a growth rate. And I'll show you why we don't need a growth rate in anything here. We don't need a growth rate. And illiquidity discount, yeah, we did that. Oh, okay. In place of the growth rate, we can include the persistence factor. Persistence factor measures the persistence of the residual income. And for now, let's include the persistence factor. Then let's leave the persistence factor at 1. Now, let's make it 1 for now. Persistence factor of 1. Now, sustainable ROE is, let's leave it at the 25. We just have it, just a normal number we have there. So the terminal value will be, and you remember the formula we use for a terminal value. So we're going to have, guys, I'm praying the light doesn't go on, right? It's going to be the sustainable ROE at this point. Anything can happen, my light can go off. In case it does,
Please, hello, hi everybody. Julius will be joining, reconnecting again. I mean, we'll be connecting again. We just had an internet glitch, not lights out. So please, give me a few minutes to get back on. Thank you. Okay, so please, in the meantime, I will be in the chats responding to any questions you may have about the CFA program, the CFA exams, CFA Society Ghana, the scholarships available, and all that whilst we wait for Julius to get back. Thank you.
hello guys. I'm so I'm so sorry. Um, I'm so sorry about that. I I don't know. Suddenly my internet went off, even though I still have light. I don't know, just because I kept saying that the light will go off on me. Okay, so let's proceed. So putting some formulas in here. Okay, oh my God. Jordan. All right, thank you. All right, so we put in some formulas in here. So we said that the terminal value will be the return on equity minus cost of equity divided by 1 plus the cost of equity minus the persistence factor. Okay, so this is what we have. The formula. We hit enter and I give a 0. And this is not entirely 0, right? This is the term. We need to multiply this by the beginning book value of equity. But listen carefully. At the end of the terminal value is calculated at the end of 2029. So the beginning book value to use for terminal value calculation is the closing book value for 2029. So we do that now, we hit enter, and this is what we have. And the question is, why do we have this huge negative? Okay. The simple assumption we used to start all these things is that we stated that the sustainable ROE is 25%. Of course, this may reduce, right? It's 25%. And that's the reason why and that 25% is lower than the cost of equity of 27.8. And that's the reason why we have a negative terminal value. But we're just building the model, right? Now, that being said, what's the next thing to do? So we need to calculate our discount factors. So we have periods. Then we have the cost of equity already. At the top, we can bring it down again, cost of equity. And then we have the discount factors. So the period 0, then we have 1, 2, 3, 4, 5. Then we have the cost of equity. Again, then we lock it. It's the cost of equity. We have that here as well. Then we have this. Then discount factors. The discount factors here, we will not do for 2025 because we're not discounting anything. So we have 1 plus the cost of equity to the power negative the period. So this will give us the discount factors. We have them here. So the discount factors, I can put them in bracket like this. So the discount factors will be used to discount those residual incomes that we have there. So let's check that out quickly. We will have, so the present value of residual income and then the present value of terminal present value of the terminal value of residual income. So we have these multiplied by the discount factor. Of course, it will be 0, and that's what I expect. And then, sorry, what did I just do? And then we drag to the end. Then we also do for these, the terminal value here multiplied by, not because there's a terminal value in year 1, but look, we just put it in formulas, right? As placeholders. So we have this. And so we have the present value of future residual income. And that is this. And we have this as the present value of future residual income. Then we also add book value of equity, or beginning book value of equity. We have the beginning book of value of equity here. And we know the beginning book value of equity. that is the closing book value of equity for 2024, because we are valuing the bank as at 31 December, right, 2024. So we have the closing book value of equity as the beginning book value of equity. So we do that, and then what do we have? This will help us to get the intrinsic value of the bank. Let me delete this part. So in this case, we're able to get the intrinsic value of this bank. And you see that the beginning book value of equity is even more than the present value of future residual income, right? Okay, so let me even give some space. And then there'll be some adjustment, right? Adjustment that will be done. So sometimes we call this due diligence, and I'm going to update the FCFE model side to due diligence adjustment. So if the adjustment, in fact, in the FCFE, I rather say adjustment for loan losses, blah, blah. But then the whole idea is that we can do due diligence adjustments. So we can do adjustment for loan losses. Let me indent it. Adjustment for loan losses. And all that. So when we do those adjustments for loan losses or maybe additional impairment or something like that, we can do additional impairment. We call for additional impairment as well. And so when that is done, then we get adjusted intrinsic value, right? Adjusted intrinsic value. Maybe let me do it properly. This plus the sum of this. And then that gives us the adjusted. Then we have a liquidity discount here, which is the crossover we have here multiplied by a illiquidity discount of 10%. And of course, we put a negative by it. And then we have the adjusted intrinsic value. Of course, book value is still brought here. And so we have justified price to book ratio based before illiquidity discount. And I want to maybe here, because I brought book value of equity earlier, let me take it off from here and rather do it on this basis. So before illiquidity discount, the adjusted intrinsic value divided by the, let me see something, before divided by the book value of equity. And then the second one is this divided by the same book value of equity. So book value of equity, we have that also done. So this is what we do, and this is what we have come up with as a valuation for the bank. All right. So this is the bank's valuation based on some assumptions that we just play with. This is the valuation we have come up with for the bank. Let me see something quickly. So I can put this border at the top. I can also, let me put this also this way. We coming to do due diligence adjustment. After due diligence adjustment, we have liquidity discounting. Then the final one, we have the estimated value. Something like this. And then we have the justified book values and blah, blah, blah. All the other adjustment and things all start from here. And we have this justified start. Now, so I think there's a question, and let me check what is in the chat box. I mean, the present value of FY 2024 is incorrect. Present value of FY 2024. No, we're actually not discounting. If you say it's not correct, I don't get it. We are not. It's not going to be part. It's not going to be part. The value, this one, we just calculated it here just to show maybe for a current year or something, but it's not used because we are discounting things in. Look at this. Present value, future, whatever. It should just be the future. 2024 has ended, right? So it's in the future. I should have actually brought it here again. Something like this. Let me check the chart again. Okay, I see. Okay, great. Thank you, Ibrahima. Now, you see, guys, these are just some few assumptions I play with. We are not saying these are the final numbers. These are just assumptions I play with. I mean, as far as the valuation assumptions are concerned. Now, if I change the persistence factor, this persistence factor is showing that residual income will not persist beyond this point. If I change it to 0.5, check what will happen. You see, it has increased. If I make it 0, which means residual income will persist forever. You see what happens? Okay, so let it still be at 1 for now. What else do I want to do? Now, as it stands, this is a residual income model for the bank. It's more reasonable than the free cash flow model. You see the reasonability is there as far as GCV numbers are concerned. You see it's more reasonable. The sustainable ROE, if I move this to the ROE for the top 5 banks, let's see what happens. What's happening? Okay. Let's move it to ROE for the top 5 banks and see what happens. You see what happened. You see the figures are bloated out of proportion. When we move it to ROE for the top 5 banks, and that has increased the justified price to book ratio to 2.53 or something. But the same ROE for top 5 banks we did yesterday, and it took the computation out of gear. I mean, for the FCFE, the figures were very unreasonable. So the residual income model tends to do something great, right? For now, let it be at 25%. Now, we're going to look at the last methodology, and then you close for the day, because tomorrow is the day that we're actually going to discuss the figures in detail and all these assumptions. We are going to discuss the figures in details and optimize them to ensure that we get a very good value based on several assumptions. Let me see. So are the assumptions based on buy side or sell side? Because I know either side makes assumptions that are favorable to them. A very good one. And tomorrow, we are going to handle those issues of buy side or sell side, right? We'll handle this, so we can answer your question tomorrow. So this is the base case, right? Let's look at the worst case scenario and see where it takes the bank in terms of the residual income model. Worst case scenario is placing the bank here. Based on assumptions we are using, this is a worst case valuation. This is where it's placing the bank. Let's see the best case valuation. And some of these base case, worst case things, we are going to rework out assumption tomorrow. You'll rework out assumption rigorously tomorrow. Best case. Let's check best case. Wow, you see best case. So what we do tomorrow is that tomorrow we'll get into the assumptions and work it out. Work out assumptions properly. Now we'll consider other factors now in the decision making until we arrive at something that suits all the factors, taking all the factors into consideration. So what we are still doing is that we are still looking at the building the model. We're just building the model and making very simplistic assumptions. We are going to optimize the valuation model. All right. You know, we've not even placed in here size premium, company specific risk premium. They are all not here. Don't forget. And those are our businesses of tomorrow. That's why tomorrow class is critical, because we're going to discuss a lot of things, and which we're going to look at the art and sciences of things, right? The first part we'll look at that. The second part we'll look at, okay, we'll do some simulation. And you'll do multi-color simulation tomorrow. You'll do multi-color simulation tomorrow. All right. Let's see. Now, so first part is over. We have about 33 minutes to go. With that 33 minutes, let's look at the second methodology. I'm switching straight to the PowerPoint for us to get into it You look at it from a PowerPoint side, understand the methodology, and then you come to the Excel to complete it. Good, PowerPoint. And is my screen visible? Is my screen visible? So we have relative valuation. Okay, my screen is visible. Thank you, guys. Let me grab water, a glass of water, just 30 seconds, please. All right, I'm back. Is there a question? Okay, thank you, Kweku. Okay, so let's get it here. Now, what are multiples? We talk about relative valuation. So we are valuing a company relative to the other. I gave the overview before. So what are multiples? And so every multiple we have or we see, and I believe you've seen multiples before. So when I'm approaching some of these lectures, I assume some basic knowledge. And if I say basic knowledge like what multiples are and all those kind of stuff, they tend to be basic knowledge that I assume in terms of like, some of the few multiples like price to book, price to earnings and stuff, right? Now, so every multiple or multiples have a numerator and a numerator. Now, the multiples have to be consistently defined. The numerator is often a representation of what you are paying for the company. What are you paying for the company is often placed in the numerator. The denominator often takes what you are getting in return. So for every multiple, we see the numerator, which talks about what you are paying. The denominator is talking about what you are getting. So you see how consistently multiples are, why we use them. Because I have what I'm paying at the top and what I'm getting below. And so that's kind of like a relationship between the market and the financial statement. So that's another way of looking at it. It spells out the relationship between the market and the financial statement. The market is at the top, the financial statement is below. The market is what you are paying, and the financial statement tells you what the company will give to you. Okay, good. So oftentimes in the denominator, you think things like the market value of equity, right? The market. So if you want to buy a company stock, you pay the market value of equity, market value of the firm, which is market value of equity plus market value of debt. So they are all market value stuff, right? And then enterprise value is also another often used. With enterprise value, you have market value of equity plus market value of debt minus cash. So that's enterprise value, right? So if we take the market value of the firm minus cash, it gives us the enterprise value. Oh, sorry. So these tend to be the common numerators of several multiples. Now, so the market value of equity tends to be represented by letter P, right? The price. And so the denominator tells us about what you are getting in return. So there are multiple options here. Revenue is one. Revenue can be used as denominator. So when we use the market value of equity in the numerator and revenue in the denominator, we get price to sales ratio. And we can also have earnings, right? And when we take a market value of equity at the numerator and earnings at the denominator, it gave us price to earnings ratio. And then we have also cash flow, we have book value. And book value, you can see that clearly. If we take the book value at the denominator and take the market value of equity in numerator, it gives us price to book ratio. And same way with the cash flow and the cash flows, we have something like EBITDA. If we take EBITDA at the denominator and have enterprise value at the numerator, we have enterprise value to EBITDA ratio. So that's how multiples are defined. And so always check that the definition of the multiple you are using is consistent. You always have the numerator being what you are paying for the company and the denominator being what you are getting in return. So you pay, for example, for price to earnings, you pay the market price, you get earnings on the P&L in return. For enterprise value to EBITDA ratio, you pay the enterprise value, you get EBITDA as return. And for price to book, you pay the price, you get a book value return. So that is it. So if we have a price to book ratio of 1, it means that you pay 1 cedi to buy the company and you are getting exactly 1 cedi in return from the company. If EBITDA price to book ratio is less than 1.2, it means that you are paying 1.2 cedis per share and you are getting only 1 cedi return from the company. If it is otherwise, like 0.8, it means you are paying, let's say 0.8 cedis, which is like 80 pesos, and you are getting 1 cedi back in return, right? Good. I hope that this particular presentation communicates the point. When we move to the next one, on the fundamentals of multiples, when I started evaluation, I said that underlying every valuation formula or every valuation methodology are assumptions around growth rate, risk, and cash flow. So these are the 3 fundamental drivers of value. The growth rates, that's the growth associated with the cash flow, existing cash flow. And this growth may arise from growth in investment in new assets plus efficiency gains, right? And so that growth cash flow plus the cash flow for existing assets plus the risks associated with the business, with the cash flows, those 3 define the value of a business. They are the fundamental drivers of value. So in every formula, we can see all those 3, where be it discounted cash flow or relative valuation, those 3 assumptions are always made. Okay. So the changes in those assumptions also change the multiples, because if we say that even all the multiples can be decomposed into these 3 components, then it means if the multiples or if the fundamental drivers change, it will result in a change in the multiples as well. Now, this also means that when we want to do relative valuation and we sample companies, okay, we select comparable companies, we can look at their multiples, and more than ever, we can also decompose the multiples to see what is driving them. And instead of us to just compare at the level of the multiple, we will do the comparison at the level of the individual drivers. Which companies are growing faster? So we will gather fast-growing companies, right? We call them the growth stocks. Okay, which companies are matured, are having stable earnings? Well, we can see them because their growth rates are lower. We gather them together, those we call the value stock. Is that okay? Okay. So the risks associated with them also, value stock tend to be less risky because of the predictable cash flow. And then, so they are likely to attract a lower discount rate compared to high growth stocks that are considered risky, like IT, technology stocks. Right. Good. So note that those are the 3 fundamental drivers of value. Moving to the next one, where we looked at the most important multiple for valuation of a bank, which is the price to book ratio. How do we calculate it? I told you already that the price to book ratio, there are 2 ways to computing it. One is the market value of equity divided by the book value of equity, and that's what we know. There's another way of looking at it. You can also express it as enterprise value divided by invested capital. where enterprise value is the market value of equity plus market value of debt minus cash, divided by market book value of equity plus book value of debt minus cash. But I know for the purpose of a bank, the first one suffices, right? But you see something beautiful happening here. If I know the price to book value of a company, in the second formula, if I know the price to book value of a company, not a bank, and let's say an industrial corporate, we know the price to book. I know the market value of equity, and I know the cash the company has. I know the book value of equity. And I also know the book value of debt. I know the cash as well. Don't you think I can calculate the market value of the debt? Even if I've not done discounting of the debt, I can still come up with the market value of the debt. If I know the price to book, I know the market value of equity, I don't know the market value of debt, and I know other quantities, other value, I can come up with a market value of debt. And that's a beautiful part of this formula. So there is some internal consistency here. You have what you are paying at the numerator, and you are getting what you also have what you are receiving at the denominator here. And you can see that what you are receiving is often from the balance sheet. So, sorry, from the financial statement. And what you are paying is from the market. So the multiple help us to establish that relation between the market and the balance sheet, right? Let's decompose this price to book. I said to you that underline every multiple are assumptions about cash flow, risk, and growth. Let's see whether that is true. We are going to decompose the price to book ratio soon. Now, to start that, we are going to use a discounted or a dividend discounted model, which is a simpler model. And with the dividend discounted model, we can transition from there to the price to book ratio. And let's see how the price to book ratio relates with the model. You'll realize that the dividend discounted model is DCF approach, discounted cash flow model, income approach. But the price to book is a relative approach. But I'm saying that the same fundamental drivers are driving both cash flow, risk, and growth. So when we check the formula for the discounted or dividend discounted model, this is the formula. The price of the share is equal to the dividend per share, and this dividend per share 1, which is the next year dividend per share, divided by cost of equity minus the growth rate. So this is the formula for the dividend discounted model to calculate the share price. Okay, here we are assuming a constant growth in dividend, and that's what we have here. Beautiful. So in this formula, we can see all the three drivers of value. The numerator dividend per share is the cash flow. The KE here is the risk measure, and the G is the growth. So all the three are there: cash flow, risk, and growth. Now, we want to also establish that the price to book ratio also is driven by the same three fundamentals. Let's see how it goes. We are going to do some few substitutions here. Number one, the dividend per share is given by the book value times the ROE times the payout ratio. Oh, guys, you remember something. The book value times ROE will give us the net profit or the earnings after tax. The book value times the ROE will give us earnings after tax. So earnings after tax multiplied by the payout ratio will give us the total dividend. But here we are working on a per share basis. So I should have done this correctly. I should have said book value per share. That's what I should have done. So book value per share times ROE times payout ratio will give us the dividend per share. So this dividend per share is now represented here. And you'll see it here that the book value times the ROE times payout ratio. This is the dividend per share. But you see in the dividend discounted model, the dividend per share we're dealing with is the next year's dividend per share, right? The next year's dividend. So we need to grow it by 1 more year, which is 1 plus G. We used to grow it. So we're able to transform the DPS1 into the numerator we have here at the top. We still maintain the denominator, which is cost of equity times the growth rate. We still maintain it. Now, I hope that particular this stage, how do I call it? The step so far is fine. Let's move to the next step. So the next step, we are going to divide this formula through by the book value per share. When we divide through by the book value per share, the book value here in the numerator vanishes. So you can see in the formula below, there's no book value again. And now we divide the P naught also by book value. So we have price divided by book is equal to, then the book value in the numerator values. So we have ROE times payout ratio times 1 plus G. Can you still see what is happening here? We have price to book ratio being equal to this. This is so beautiful. We have price to book ratio being equal to this. Now, let's see whether the three fundamental drivers are still here. Now, ROE times payout ratio is the cash flow. And we can see it. ROE times payout ratio is the cash flow. And the cost of equity is the risk measure. And G is the growth rate. So we can still see them here. Let's proceed. Now, we saw ROE times payout ratio divided by KE minus G. Let's look at this side. Now, every multiple has a key driver variable. In the case of price to book, it is the ROE. Because it's the ROE. Why? Because the payout ratio may not necessarily be increased. A company can have a well-defined dividend policy. In that case, they maintain the growth in dividend. So the payout ratio can be maintained. And then we have the growth in dividend being also maintained, right? Consistently. But the key driver, what makes the company to pay more dividend or not, is the return on equity. If they do more, if they generate more profit, their return on equity too will be higher, right? In that case, return on equity is a key driver here. Now, so if the return on equity is based upon next year's forecast earnings, then the formula simplifies to this. So this is what I'm trying to say. The return on equity, as we have it in the formula here, is the return on equity for the previous year. If we have based the return on equity calculation on the next financial year, or we have the forecast return on equity, then this 1 minus G will vanish. We will have return on equity just for the forecast year. So the formula will simplify to this. So this is the forecast return on equity. I hope we're still making progress. Now, that being said, we can further simplify the above by relating growth to the ROE. Now, we know that yesterday we found out something very beautiful. We said that 1 minus payout ratio is equal to the retention rate. 1 minus payout ratio is the retention rate. And when we multiply 1 minus payout ratio by the ROE, it gave us the growth rate, the retention rate, times the ROE. We retain you retain percentage of the profit and reinvest it at the ROE, and that it brings growth to the business, right? That's what we said yesterday when we were doing the FCF model. So that's the growth rate. So if 1 minus payout ratio times ROE is equal to G, then we can do some beautiful work. We can actually make, let's say, ROE the subject of this equation here, and then substitute it here. In other words, we are going to substitute G divided by 1 minus payout. Okay, G divided by 1 minus payout. We will substitute it in place of, I think, let me not do it that way, rather. We want to, okay, guys, let me take my words back. What we want to do here is that we want to make sure the payout ratio vanishes from the formula. But even before the payout ratio vanishes, guys, can you see that if a company pay a higher dividend out, it's likely to increase its price to book ratio? So you can actually see higher return on equity will increase price to book ratio, higher payout ratio will increase price to book ratio, lower cost of equity will increase price to book ratio, and higher growth will increase price to book ratio. We can all see that, right? Good. But then there is a key assumption, which is that the cost of equity should not be lower than the growth rate. Otherwise, we can't use the formula again. But let's look at something here. We want to make sure the payout ratio vanishes. So we are going to make payout ratio the subject here. So when we make payout ratio the subject here, what we do is to make the payout ratio the subject here, it's just a matter of multiplying 2 by ROE. So you have 1 times ROE, which will be ROE, and then 1 times ROE, which is ROE, minus ROE times payout, right? So we can make the payout ratio the subject by doing G minus, maybe another way we can do it. We can say ROE minus G divided by payout. In fact, that's how the formula will be. ROE minus G divided by payout. In fact, I'm not doing anything difficult. I'm just making payout ratio the subject. So I'm expressing payout ratio in terms of ROE and G. So when I replace the payout ratio by that in the formula here, then it simplifies to this formula. This is one of the most beautiful formulas you see in equity valuation. That the price to book ratio is equal to the return on equity minus growth divided by cost of equity minus growth. Now, so if I take the price to book ratio, it is simply this. And do we have all the 3 fundamental drivers here? Yes, ROE is the cash flow, G is the growth rate, and KE is the risk. Now, so with this that we have, we can actually calculate price to book ratio without knowing anything about price. All we need to know is the return on equity, the growth rate in earnings, and the cost of equity. We don't need to care about price. But there is a name for that particular calculation or this particular formula. It gives us a price to book ratio, which we call the justified price to book ratio. Why do we, and is a price to book ratio justified by the fundamentals of the company? So what we often do sometimes in when we're dealing with securities is that we look at the price to book implied by the market, which is the market price itself divided by the book value of the company. That's the one implied by the market. Then we also take the price to book justified by the company fundamentals. And the company fundamentals here is the ROE and a growth rate. So this formula. So when we compare the price to book rate ratio calculated using a reference to the market and looking at the one justified by the company fundamentals, then we can see whether the company stocks are overvalued or undervalued. Now, so that is one thing I want you to take note of. Now, I want you also to see something. When you are using that to draw a conclusion, you need to be a bit careful. The reason is that the growth rate we are seeing here is a constant growth rate. So what it means is that we assume that the company in question is a matured company that is growing, consistently, or that is experiencing a stable growth. So a matured company experiencing a stable growth is more likely to use the formula here. Or not that it's more likely to use, but when we use the formula here, we tend to get a more reliable calculation. Okay. Any question? I hope you've understood everything I talked about now. And I've explained the price to book ratio to you and how it relates to the discounted cash flow models. But then before we proceed to the SL, we go back to the SL. Before we do that, you would notice something. When we're dealing with the residual income, what were the big things that we looked at in the residual income? The residual income formula is based on what? Return on equity, okay, and cost of equity. Can you see all the two here? They are in the residual income as well. All the two are in the residual income as well. Right? Those are some of the beautiful part of this. The beautiful part of this assignment. Okay. I'm just checking something. But well, it's fine. So there's a strong relationship between the price to book ratio and the residual income. Right. Good. Any question? No question. Let's go back to the Excel to complete the assignment for today. Let me share my screen on the Excel. We know tomorrow is the final day, and tomorrow we are going to evaluate the model results. We're going to do that rigorously. And guys, I just want to say tomorrow I will take longer time than ever. Look, myself, I'm not happy to make this long, or maybe just be here doing all this. If I say I'm not happy, I mean, not like I have much time, right? But tomorrow, we need to start exactly 5 o'clock, and everyone on the call, please listen to that carefully. We need to be in before 5 o'clock. We are starting exactly 5 o'clock. And the reason is that I want to use about 3.5 hours tomorrow. So I want to close 8:30 tomorrow. Tomorrow is the last day. Let's all sacrifice. I want to do 3.5 hours from 5 o'clock to 8:30 because I'll do a lot of simulation. I'm going to do Monte Carlo. Perhaps a number of you may not know how to implement Monte Carlo. I'll show you how Monte Carlo simulation is done tomorrow. And we'll do simulation of future state of the share price and use that to improve upon the valuation we've done, and use that also to come up with confidence intervals for the valuation we've done. So I can do all that within 2 hours. That's the more reason why I need to take up to 3.5 hours. So let's take note and let's be here before 5 o'clock for tomorrow. Okay, good. Let's look at this. Great, my daughter and Nelson, thank you. It appears Michael is not happy with that. Oye is not happy with that. Now have never been happy with that. Sifas to claim, and Gilsborn is not happy with that. Ibrahima is never happy with that. Kweku, I know you are not happy with that I said, and several of you. Don't mind me. Good. Great suggestion. All right, thank you. Now let's put the last model here, which is the relative model, right? Let me duplicate this. Is 4 minutes of time. I will not waste your time today. Let's just set the skeleton. Tomorrow we can proceed to really look at it, but it won't take much time, right? Because we are using just price to book ratio, so it shouldn't take much time. So price multiples or market multiples. So that's all we have there. So we'll set it up and we'll close for the day. And then we will see how it goes. Okay. All right. So market multiple. Let's set this up. Market multiples. Okay. So I'm going to do things a bit differently and then the market multiples. So let me delete a lot of the things here. As I mentioned, we will just set the tables up for tomorrow. We're gonna and let me tell you this thing. I don't have anything written anywhere that I'm looking at, right? So I'm producing all these things from my mind, and because I've been doing this thing for quite a time now, and it's just interesting sometimes, right? So we can call this place market data, right? Market comparable data. When I do this in practice, I may have another worksheet where I'll do detailed comparable company or comparable bank selection several criteria and all that. But usually we tend to, if you have subscription to Capital IQ, you can use Capital IQ to do your screening, right? So here I'm assuming that you are screening this from Capital IQ, or maybe you compute this yourself based on the market, the market. Because sometimes the Capital IQ multiples, sometimes understanding how some of these things are computed is a bit some way, because you don't know the share price they are using, whether it's the year-end share price or average share price to the end of the year or something. You may not know, right? But let's say, okay, well, let's list the bank. So comparable universe. So we have Standard. Standard is listed. Standard. I have EcoBank. I have Access Bank. I have Société Générale. Société Générale. Then Standard, EcoBank, Access, Société Générale, ADB, and then let's list all of them. Now, ABSA is not listed on our market here. I think I'm left with Republic Bank. Republic. I think that's all. I think there was 6 banks, right? Listed on the Ghana Stock Exchange. Isn't it? So let me see, 6, this is 32 companies or something. I think I have one more or something. Which other bank, guys? My mind. So Standard is here, EcoBank is here, Access Bank, or maybe we can just do a simple search and just get data on the rest. Banks listed on GSC. So I'm not showing my screen. Okay, listed companies on GSC. I don't want to show my screen at this point. So ADB, Access, AGA. I think somebody has done something. Of course, I'm happy with, even though we will finish the session with GMT +2 on my side. Ah, you're in France. Oh, okay. Oh, sorry. That will be around 11. 10:30. Ah, you'll manage. Ah. All right. BOPV, GADB, LASW. Cow. Oh, Cow. I should never have forgotten Cow. Bank. How come? Cow. Okay. Because we are looking for comparables of GCB. We don't include GCB itself, right? So comparable. Or comparable banks. And here we are looking at just the GSC. And so the banks I want to have the ticker symbol. That's 1. 2, I want to have, as I mentioned, we'll just set up the work, the template, and I have the ticker symbol. I want to also have, what is happening to my, okay. I have the ticker symbol. I have the, let's say, earnings. I have the earnings. I have the average book values and average book value, and so that based on that, I can compute based on average book value, I can actually compute the, how do you call it, the price to book ratio, right? The price to book ratio there. So I have these things here. So these are the things I want to do. For the banks, comparable companies, or maybe I can even, let me look at this. Okay, so let me rather say the comparable company here, and so I can delete this. I don't see why I should have this here. So I have Arial. Oh my goodness. So this is Arial. And let me reduce this to 12. Okay. I think there's a chart. Why don't we consider some bank outside Ghana, SSAPS, given that most of these comparable banks are largely trading at depressed levels due to GDP and may not give a relative value to GCB? Yeah, you are right. You are right. So what I'm doing is that this table is for GSE. I'm not done. So this will be for GSE. There will be another table below that will have some comparables in the sub-Saharan African region. So I'm going to have that. Okay, thank you very much. That's spot on. But it's part of the things I want to actually do. Okay, good. So we have this, and let me put this in a nice table. Put this in a nice table. And then the second thing I want to do is to have the comparables for Africa. I'm being tempted to use this color rather. Okay. Now, so let me do this. Now, so the second table I want to have here will be for comparable banks, sub-Saharan Africa region. And let me put this. Now I have a reason why I have to. So I have this. So this should be 31 December 2024. And it should be January 31 December 2024. Oh, I think okay, so I need what to do. Let me make it test. Test, what is test? What is test? 31, or I bring this first, 31 December 2024. Okay. My December calculation. Okay. Okay, good. I think this question. Okay, so December, the spelling. Yeah, so I've done that. Thank you very much. All right. Shout out to Ifri. Good. So you'll have some banks listed here tomorrow. Okay. So I'll give you some comparables tomorrow. And then when we do this, we have the price to book ratios for these banks. That'll be basically oh, I have earnings right here. Oh, no one told me this. So not earnings I wanted to write. I wanted to write market cap. Or market value, right? That's what I wanted to write, market value. And then we have this here. So I have if error, the market value divided by the average book value. Why am I even writing average book value? You know, when I was writing average book value, what was coming to my mind is that excuse me, let me check something. what was coming to my mind is that I'll do some return on equity stuff, right? Book value. But I will still need that return on equity work done somewhere. So I'll show you where I'm going to do that and why I have to do that for the various banks. So market value divided by the book value, and then comma, if error not applicable, bracket close. So we close this, the formatting. So we have this, and there's something I want to talk to you about. You see, in my selection criteria, I would like to compare the return on equities generated by the various banks as well. That will show me which ones I will consider as comparables. Okay, so in fact, let me even call this comparable universe rather than comparables. Comparable universe. Let me select my universe. And then I'll do some things based on some criteria. Then I may come up with my assessment. And so one thing I may want to also see is the return on equity of the various companies, because you know that the price to book ratio can be decomposed into the return on equity minus the growth rate divided by the cost of equity minus the growth rate. So return on equity is one thing I want to use for the selection as well. And maybe another thing I can use for the selection, apart from this, will be the growth in earnings. Earnings growth. Earnings growth. Earnings growth is another thing I'll do. Earnings growth. Of growth, let me just say growth rates. And so I'll use growth rate as well. So this is my universe. And then from here, from my universe, I can come out with my comparable companies. So my comparable companies, let me bring this here. Selected comparables. So we are going to do the selection based on fundamental drivers rather than just looking at, oh, we are all banks, we are all this. No. So price to book ratio of the various comparables, of the various comparables that we selected. Okay. Then I also want to, with this price to book ratio, I can actually come up with, based on this, I can come up with some statistics on the mean, the median, and all those kind of stuff, right? So this is just the ones I'm selecting. Maybe let me bring this particular table to this side instead, and on my selected comparables. So I have this here. I can drag this to the side, so ticker symbol and everything here. So I will have my selected comparables here. Let me see. Let me shift this thing up. Let me shift this thing up a bit. Shift it up a bit. Okay, good. So the next thing I'll do is that I want to get some statistics. So I'll look at the median. I want to take the median or what okay, so I'll do the median, and also I want to see the first quarter as well. Or let me put it this way, first quarter, then I'll have the median, then I have third quarter. So I want to check this first quarter, median, and third quarter. And out of that, I'll be able to come out with my appropriate price to book ratio, the one I want to select for the valuation I want to do. Now, so I can delete whatsoever is here now. And what I'm going to do here is the quartile is not anything quite difficult. So I'll just bring my quartile here, bring the array, and then comma. So this is the first quartile. And I put 1 there. And then I have up to this side. The median is the same as the second quartile. So I'll replace the 1 by 2. And then the third quartile here is where you have that represented by 3. In fact, I can put the if error formula just in case, so I can handle my errors appropriately. Then this side to the same, and maybe rather let me drag this down, and then I'll make the changes. So this will be 2, and this will be 3. Okay, so I have my quartiles also done here. Then I can now make a decision on how the value should be based on the various quartile stuff and all that, as to which one I want to base GCB's value on. Right. Now, so from here, I want things to be well aligned. So let me move this one up a step below which will blot out this. I think let me just do step down, shift down. Okay, so here I want to start looking at the information on GCB itself. So I'm going to, so let's say these are selected comparables. So here, what I want to do, I don't know why I moved this way. Let me delete this, shift up. So what I'm going to do here is that I'm going to, on this side, I'm going to say GCB, okay, relative valuation, or just say valuation, come to GCB valuation. So here I'll need some few things. So I don't have to necessarily have these 3 columns. I just need one column for my valuation work. So I'm going to delete 1, shift to the left. And so what I want to do here is that I'm going to have GCB book value. So all we need is a book value. Okay, GCB book value. And then we also need here, once we have the book value, we can actually calculate the whatever. So we have the multiple, comparable multiple. So we can say comparable multiple. So we have that multiple there. And then when we multiply that, we get market value. So this is how we do. So this is the relative market value. So we can call it relative market value. So this is what we're going to do. Now, there is one more thing I want to introduce actually. Maybe I should have extended this thrice. So I'll shift this. I think I should have done that. Let me create another one again. Another one again. I want to show you, and this is the last thing I'm doing, then we close. Just to set these things down. So this will be the valuation based on first quartile. So first quartile valuation. And this is the median. And this is the third quartile. You see these things, third quartile. Okay. So book value, then we have the book value here. That will be on which date. Our valuation date is this. We have it all spelled out here. And so we have the book value. We have the comparable multiple. And the comparable multiple, of course, we have the first quartile being this. We have the median, which is the second quartile. And then we have the third quartile. I didn't use mean because mean tend to bias multiples, right? Mean tend to bias multiples. So relative value, in this case, then will be the book value multiplied by the price to book multiples, as we have here. Okay, so this is what we have. And then we base the valuation on either of these. And we can also look at GCBs trading price to book ratio or GCB trading valuation or trading value or market value. Okay, trading market value. And so you get GCB's trading market value here as well. Then we can determine whether it's undervalued or overvaluation. Undervaluation. So undervaluation, and we'll include yes or no here. So it will be that if this is this, then say this. If that is that, then say this. If this is that, then say this, right? So it's more of like to saying, if this is greater than, this, so in other words, if the market value is greater, then what we do? Market value is greater, then we can say that there's an overvaluation, right? Greater market value will mean overvaluation. So we can say yes, there's overvaluation. And then if the market value, or there are just two possibilities, either it's greater or it's not greater, right? So otherwise, no. So currently it's an error because it can compare. So that's what we do to determine whether it's yes or no, and then we determine whether it's overvalued or undervalued or whatever. Okay. All right. So as it stands now, that is what we are going to be doing. And when we come tomorrow, we will finish this up before we look at the main business for tomorrow. So we'll carry it from here, and it's good. Sometimes it's good. So that when we meet tomorrow, we are going to take it straight from here, and then we proceed to more advanced things. So I just said some of these things, and I may create more tables tomorrow again when we meet. Oh, great. Thank you very much, and I hope you had a great time today with me. And it's exactly 51 minutes past 7 or 9 minutes to 8, and I'm happy to have you here today once again, and also a pleasure. And let's meet tomorrow at exactly 5 o'clock to close it, and in a beautiful way. We'll have that close. Tomorrow will be a wonderful time again. And over to you, Ifri. Let's have Ifri on. Okay. Thank you. Today, Ifri decided not to speak.
Oh, I am here. I was just trying to set up. Okay, so we would continue tomorrow as we wrap up the entire masterclass during tomorrow's session. So enjoy the rest of your evening, and we'll see you all tomorrow.
Thank you,
Jordan. Thank you, everybody.
Thank you, guys. Thank you, everyone. Great.